Hello traders, it's Samurai Trader here. Welcome to this members Q&A session. We'll be covering a number of questions from members on both Forex and futures trading. As we get underway, as always, we need to display the risk disclaimer. Most of you watching this video are members, so you've seen this on every recording. If you haven't read it for some time, please just review the disclaimer. One of the questions that I received this week was if I could just display the websites where I obtain our news from, and there's two sites that I like to go to: Forex Factory and Econoday. Econoday will pick up more red flags news announcements, particularly when it comes to equities trading. So if you're a futures trader, I would review those sites on a weekly basis. Now, another question, actually it came in 3 or 4 times this week, was questions about the number of setups. As I say on most videos, I recommend that you focus on mastering 2 or 3 setups before you move on to another one. And just remember, traders, that we are snipers at it, so we want to wait for the trades to come to us. And a mistake that even I still make, and nearly every other trader makes, is going out there hunting for trades. That is, in a quiet time or in a consolidation zone, not waiting, a lack of patience, if you like. And it's something that we need to really work on, and many of you are aware. This is a poster I actually have printed out in my office. I'm patient, I'm disciplined, I'm focused, I'm a sniper, one shot, one kill. I'm a rules-based pattern trader. That works for me. Is there something that will motivate you or will help ground you when you're trading? I recommend that you have something like that in your office or above your screens, just to help ground you when you are trading. Another one was on stops and targets. Now, there's been a number of studies done on traders that use wider stops and traders that have smaller stops, and the results of these studies, generally speaking, basically state what you lose on a roundabout, you come out, you gain on the straight. So they're virtually the same. If you've got a really tight stop, yes, you'll be stopped out more often, but you'll not have those major stop outs. But likewise, in a whippy market, of course, you can be taken out too early. So it's something you've got to really work out and keep statistics on what works for you. Now, many of you are aware that I like to have my stop with futures trading, particularly 1 or 2 ticks above the closest swing high or swing low, provided it does not exceed the maximum size stop. For an example, on a 550 chart on ES, I like to have a stop of around 6 ticks. On, say, CL crude, I like to have a maximum stop of 7. But where I'll increase that stop by 1 tick is, let's just say I enter the market, and let's just say using a market order, and my stop loss of 7 ticks puts me right at the high of that swing high or swing low. What I will do is increase my stop by a maximum of 1 tick. So my stop ever is 8 ticks. And if, say for an example, I've entered the market, and I had a case the other day where we're in a really fast moving market, I had a 3 tick slippage on my market entry. In that particular case, I was 3 or 4 ticks under the swing high in that particular case, but I still used a fixed stop. That is, we're momentum traders. So technically speaking, if we are momentum trading in a fast market, the trade should keep moving in our trend direction. So I will use a fixed stop of 7 ticks in a fast moving market. If the market slows down, to me something has changed. That is what works for me. So you've just got to really find out your happy medium, what works for you as far as stops go. Now, another question coming in was in reference to targets, and we could spend a whole hour running through targets, and if not longer. And there's many great articles written on targets. Of course, you can have a fixed target, and let me just get back to say CL oil there. If my target is 8 ticks, I like 8 ticks. I think that works well. Once I hit +7, I will go to break even +1. I'm going to show you a couple of trade examples in a moment on those. You can trail your stop, and what you might do is have a trailing stop of 2 ticks of the high or low, sorry, not 2 ticks, but 2 candles below where the market action is, where price action is right now. So you're trailing 2 candles below, and so you're trailing as the market steps up. You're moving your stop up 2 candles, always keeping it 2 candles below. Another thing you can use is use the 8 EMA. That is, once you close under the 8 EMA or over the 8 EMA, in the case of a long, you're looking for a close under the 8. In the case of a short, you're looking for a close above the 8. You would exit your trade. Now, in slower markets or in consolidating markets, you can exit a trade very quickly. So what you might choose to use there is have your fixed stop, and once you exceed, your fixed target, I should say, and once you exceed that, then maybe use the 8 EMA. But what you got to be careful of is you don't use the 8 EMA and get whipsawed. That's just one thing you've got to really watch. You get stopped out too early. If you're using say a 34B, or particularly an 89B, I really like it on, or a 200B, is targeting a previous swing high or swing low, because they tend to act as price magnets, as do floor pivots. So they both fall in the area of acting as magnets. And what I mean by that is that, say for an example, if you bounce off a floor pivot, a very high percentage of time price action will eventually hit the R1 or the S1, and a lower percentage as you move out. The R2, for an example, is a lower probability of price action hitting R2 than what it is R1. And so R1s and S1s are a very high probability. So if you have, say, an entry just after a floor pivot, you may choose to trail your stop up to the R1. But what we also know is, of course, we'll have maybe 3 or 4 pullbacks or retracements in that time period. But it just gives you a little more confidence in re-entering the trade after a pullback. So you might take profits, say at 8.6, you get a pullback, but then a re-entry of, say, a T25 or even a 34B, and mentally you know it's a very high probability you're going to go up and price action will eventually hit the R1. So that works really well as well at targeting floor pivots. Now, next few questions I've got have come in reference to Forex trading. So this is from one of our members that just sent this in, had a number of questions. Now, this particular client was stopped out a number of times on this chart where these red lines are, and we can see here the 34 is starting to consolidate, and this is where it comes down to, and I'm pretty certain this is a 15-minute chart, M15. I think that's what it represents. So yes, it is. My apologies. It is 15. I was just looking at it, just trying to work out, because traders, as many of you are aware, I love range charts or tick charts when it comes to Forex trading. And in a 15-minute chart, there can be a lot of price action. And so you can see there where the red lines are for an hour or two on either side, you can see the market consolidating. So what is really important, that if you're going to trade, you want to definitely have a trending market, and I call it a fanning of the EMAs. That is the EMAs fanning apart. That is very important. And the gentleman that sent me this particular shot, Jeff, what I'd recommend is that you consider to maybe not using the 0 lag or the Hull EMA on the chart, but the 8 EMA, what I call the trigger line. I find nowadays the 8 is just more versatile, and so for a trade you want to see the 8 for a long trade. That is, you want to see the 8 above the 34. The ideal scenario in a fanning of the EMAs, you want to see the 8 above the 34 above the 89, and the 89 above the 200, which is what you have around that time period. But the challenging part for you there is the almost sideways action there of the 34. Now, on the other hand, if you were using a lower time frame or a tick chart or a range chart, you probably would have been in, well, not probably, you would have been in those trades a lot earlier. Now, I recommend that for members, you go to the website, and under MT4 indicators, there's an email there I once sent out where you can see a link to an app you can buy on converting with MT4 this is. So this is MT4 platforms. I'm not sure about TradeView or other platforms. I don't use MT4, so I don't know too much about it, I'm sorry. But I do know you can get an app, and it will convert the charts to tick or range charts, and you'll find them, and we're going to look at those actually an example in a moment. They're a lot smoother, so I'd consider that. So rather than a 15, look at the range or the tick. Now another important factor, and this is for all members, you may have noticed and been getting our emails, that is John Shealy now runs 4 1-hour live webinars a week, and they're held on Mondays and they're held on Wednesdays, and if you're unable to attend those sessions, they are recorded and posted in the members area. And what this means is John will cover sort of set topics, and it's particularly designed for new members, but existing members can also go there and ask questions. And for example, our forex traders, you can go and ask John questions about time frames, etc., and what he can't answer, he'll get back to you with the answer. So all members now have the opportunity of attending these live 1-hour webinars each week, and if you're unable to attend, once again they are recorded for you to view at a later stage. And just one more thing here that Jeff brought up is, yes Jeff, a pip is what a tick is. So if we look, I talk about ticks on futures charts. So of course futures work in points and ticks, and forex charts of course are in pips. So you are correct with your assumption there. So I would be looking for more of a trendy market. You can see here with that 34, it's basically horizontal, and you want to see a fanning of the EMAs, which is very important. Now the next question, let me see, that comes in here. Where are we? Let's get down to this. Okay, is journaling. And in the live trading room I've been talking about this, and I talk about this every day. Journaling what I call the good, the bad, and the ugly. By journaling, that is jotting down notes about how you're feeling, about the trades you've taken, the mistakes, the good stuff you've done, the bad stuff you've done. It allows you to go back and reflect on your actions. It allows you to go back and review mistakes and to learn from them. And I was talking about this in Thursday night's session in the live room, that it's very important also that we reframe and look at things positively. That is, we're continually beating ourselves up about the mistakes we make, where what we've got to do is convert them into what I call a learning experience. What can I learn from this? That's very important. And so we need to be asking ourselves, how can I improve this? How can I use this to improve my trading? How can I use this idea to improve my strategy? What's great about this? You make a mistake, now all of a sudden, rather than beating yourself up, I'm an idiot, I do this every time, what's wrong with me? Instead, what's great about this? What can I learn about this? What will I do differently next time? How can I learn from this? How can I use this? It's very important, traders, that you begin to reframe the questions. So they're what I call intelligent questions. They're empowering questions rather than what I call disempowering questions, which is very important. So let's now go and have a look at some of the other questions that we had on the chart. So look, I'll refer to the charts directly here. Now what we're looking at in front of us here is the Euro USD, and of course this applies to any market that I'm about to show you, whether you're a futures trader or a forex trader. That even though I'm talking about forex here, you can apply this to any market, and stocks included. And here we've got a range chart, a 4 range chart. So basically every candle here is 4 pips in size. Now what works extremely well in forex on range charts is what I call the rule of 2. You can see my white paint bar there, the super scalper. Remembering the super scalper does not plot until we've had 2 lower closes and a tick below the second candle. So 2 lower closes, a tick below the second candle, 2 lower closes, a tick below the second candle, 2 lower closes, tick below. So for scalping and for trading, this is actually called the super scalper. It works extremely well. Now, to get in even earlier, or if you don't have the white paint bar and you're using range charts, simply you're looking for what I call two candles to close in the direction of the trend, and preferably, and if you want to use this as another rule, a close under the 8 EMA, so the under what we call the trigger line. So here you can see here we've had two candles, and they're what I call full candles. Now a full candle, by the way, is where you get a candle that closes in the lower 1/3 or in the higher 1/3. Is that what that does? If you're closing in the 1/3 on the first candle, closing in the 1/3 or basically at the low of that candle, it's showing that you have something that we like in trading. It's called momentum. And so if we go over to the right here, we can see here the 8 EMA is above the 34 EMA. The 34 is now broken above the 89. Okay, so what I've now starting to get is a fanning of 3 of my 4 key indicators, showing I've got a possible new trend. And then I get a rule of 2, 1 higher close, 2 higher closes, and they both close at the high of each candle. There is your entry. Let's just say if it was here, you've got 1 higher close, 2 higher closes, there is your entry. 1 higher close, 2 higher close, there is your entry. Down here, 1 lower close, 2 lower closes, there is your entry. 1 lower close, 2 lower closes, there is your entry. 1 lower, 1 lower, there's your entry. 1 lower, 1 lower, there is your entry. 1 lower, 1 lower. So the rule of 2 works out really well. Now another thing too, on Forex, we've had quite a few Forex, and yes, you are correct, I don't pay as much attention on Forex because I'm not an active Forex trader any longer. I'm purely futures. And let me just minimize that again. But what I still have is a lot of information and videos still on Forex trading. And so attached to this video is a spreadsheet of 200 recordings, and of course there are a lot more on my Google Drive. And by the way, as a reminder, we're about to migrate everything off of Google Drive over to the members site. So only members, because there's been some naughty members have handed out links to the Google Drive. Well, that's about to stop because you won't be able to access it. Only members will be able to get hold of all of our resources, because you'll need the members password. So getting back to this though, like I'm video 116, trading Forex time-based charts. Video 119, day trading, swing trading, Forex members only. 125, day trading Forex questions and answer session. So here on the chart is videos 21, 41, 100. You might like to write this down, I should have mentioned that. 116, 125, 176, and 207. I particularly refer to you as purely on Forex, and a lot of the Q&A videos also on both my Google Drive and on this spreadsheet. You'll be able to read and watch and hear me explain a lot more on trading Forex. So have a look at that. Now range, by the way, it works brilliantly, and the rule of 2 does work brilliantly on good trending futures markets, good trending stock markets. It works beautifully on Forex futures contracts. It works an absolute treat. It's fantastic. And where it works, of course, is a bit like flag trading. If you trade flags, you need to have a trending market. So as long as you've got what we call a fanning of the EMAs, if it is you've got a good trend, the rule of 2, as does the T1, the super scalper, works an absolute treat. Now the other comment I got here is a rule of 2, then use an anchor chart. By using an anchor chart, a chart where you can refer to a higher time frame. Let me just look at this here. In this particular case, let me just do one more thing here for you just to bring this up. Okay, what I've got here, and let's just scroll along. This is Friday action, Friday afternoon. Is you can see on the right hand side I have a 377 tick. On the left hand side I have a 144 tick, and this is on gold. So what you're ideally looking for is a fanning of the EMAs, and if you look here, we can see we've got a trending 34. The little black line, by the way, is a 21 EMA. I've applied that because it works. It's a great EMA. It's a great EMA for all markets, but on gold I really like it. The 8 EMA, so you can see here you've got a separation, and now you're above the 89. The EMAs are all fanning apart. It's showing you've got a trending market, and what's happening on my anchor chart 3 times higher, the EMAs are fanning apart. So this is what I call the sweet spot of trading. Okay, this is a sweet spot. And so you can see here we've got a 34 bounce, 34B, 34B, down here at a 34B and a new trend. Remember the statement, follow the gold. Follow the gold. When price action is above the 34, you want to be long. When price action is below, and I should put the word trending in, when price action is above a trending 34, you want to be long. When price action is below a trending downtrending 34, you want to be short. Now getting back to what I was going to show you here, and that's the anchor chart. So it's ideally your trade entries are ideally both trending or trading in the direction of both your anchor and your entry chart. Now what I've got before you here is a 5-minute chart, and this is for a couple of members have brought up that are trading time-based charts, and what we've got on the left-hand side is a 4 range. Now 4 range is quite sensitive. It still can be quite slow. For an example, down the bottom here you can see here that was between 255 and 450, and sorry about that, that was over about a 2-hour period right there. So if we look at this here, and we can see here on the 5-minute candle, you can see there's a lot of price action in that 5 minutes. Okay, and if you look at down here on the 4 range, you would have been in on a rule of 2 right here well before this 5 minute. So as much as time-based charts can be great as far as you can set your computer clock, your timer, you know exactly when the candle's going to close there. So I'm not saying there's not any benefits, because there's some great benefits of time-based charts, confirming a trend direction, things like that. But if you want to get or have earlier signals or potential entries, this is where range or tick charts on Forex and any type of chart actually, or any market I should say, works really well. So here you've got 5 minutes, and you can see here we were in here well before this 5-minute move, and then we had the 5-minute move. We had then another entry on a rule of 2 here, because if you wait for a 34B, it just helps qualify the trade, and in you go to the long side. So the point I think I started to say is that 4 range is very sensitive. So if you're say don't have time for actual scalping or day trading, you might make that an 8 range or even a 12 range. It's a matter of finding what works for you. And what you can also do is turn the alarm on your T1, or you can set up with most platforms, you can have coded in that when the second candle closes, an alarm goes off if you have too high highs, etc., to set an alarm off, so you don't have to be by your computer. So something to think about. So yes, you can trade of course Forex using time-based charts. I love range or tick charts. Now the next thing we wanted to just talk about once again was targets on the futures markets. Now what we're looking at here is a gold chart, a 144 tick gold, and I shorted 2 contracts. The target on my first contract is 5 ticks, as I tend to find that works really well, and the second target is 8 ticks. Now here in this particular case, when you take, this was a counter trend trade, I had great divergence. I entered in here, so we can see there's the divergence, and most of you know I love trading divergence. I got in a little later over here. I could see I was waiting for some consolidation, and actually I'm just trying to think what happened, why I waited a while on this particular trade, and this is Thursday of last week, so we're sort of 4 days later, and so a lot happens in 4 days. So anyway, I entered a trade here. It come down, and always be prepared for a bounce on your major EMA. So therefore, if you're counter trend trading, be ready to pull your stops in or to pull your targets up. So it come down, and I achieved +5, and I went to break even, because being a counter trend trade, we know there's a good chance you're going to get a bounce. You've got to be aware of that. Now I went to break even. Okay, now in this particular case I actually got stopped out -1 tick. It actually went through my stop. Instead of breaking out at break even, it went through -1, so I was still up +4, less commissions on the trade. But just be aware of that, and I'll just say that again, that when you enter, like here, you've got a nice little double top, be prepared for a possible bounce. So what you can do is either to wait for a close above the 8 EMA and exit your trade, or just pull your stops down. Just be ready for a bounce. Here in this particular case, it come down and bounced on the 89, and of course I've done a lot of videos on this, and in the live trading room I actually did a complete session which is recorded for live trading room members last week or 2 weeks ago on trading divergence trades. But let's have a look at another trade I want to show you. Now this is another example on CL in this particular case. Now on gold, just to run through it again, on gold I use a 7-tick stop with an 8-tick target and placing 2 contracts, one off at +5 and one off at +8. Or what I don't do, but you can do of course, is trail by using the 8 EMA, or trail behind 2 contracts, behind 2 candles I should say. Here in this particular case I shorted on a 34B. My target on the first contract was +5. I got filled on that one. It then started to tick up and I went to break even. Now if it went down, if on the second contract it went down and hit +7, I would go to break even +1. But in this particular case it only really ticked down +6 if I remember correctly on this trade, and so I went to break even and it stopped me out. So one of the questions was on trading range on the ES and different markets, what size or what tick size, what stop size and what target should you use? Well, it really comes down to just spending time working out what really works best. So I find that on a 550 ES, a 6 to 7 tick stop and target works well, except if the market stalls you may choose to exit at 3 ticks. You know, it comes down to just gaining experience on when to pull your stops in. What you've got to be very careful of is that you're not doing it for pure emotional reasons, that is exiting just because the market stalls for a couple of minutes. Many of you know, if I are in a trade and it goes sideways in for 10 candles, I'll usually exit, sometimes even 5 or 6 candles, because something has changed. What we want is, as momentum traders, we're in a trade like here, this 89B, we want to get out. Okay, so there's another one I wanted to show you just on, let me just go and find it. And here's just another one here, just another two, one off at 2 contracts, one off at +5 here and one out at +8, and that was a combination of an 89 and 34B. Traders, it's a matter about just spending time working out what's the optimum stop, but ideally I want to see my stop 1 tick above a swing high, or 1 tick or even 2 preferably below a swing low, provided it doesn't exceed my maximum stop loss limit, because otherwise what happens is it throws your risk reward out. Now by targeting just 5 ticks, yes, you need to be right 75% of the time, but if you look at your 34Bs in a trending market, your T1s in a trending market, or your golden divergence trades, overall you're going to do very, very well out of those, so you're going to hit your profit targets on those. Now let me just show you one other thing here. And by the way, there was a losing trade on a divergence trade. Okay, so there was a divergence trade, there was a losing trade, and the next one, qualified trade for a divergence trade, was up here, which is also a pivot bounce. And just while we're on that, let me just show you these pivot bounces. So you can see we bounce off a floor pivot. Where's our next target? Okay, it's going to be the lower pivot. We bounce off it. Yes, you can come down and go through it, but in this particular case we then received a lower high. So where's my next target? It's going to be the lower pivot. So yes, you'll have potential multiple entries on the way down, but it just gives you a target, something to aim for. Here is another trade, a 34B with gold. We had a potential little divergence trade, and as you can see there, I didn't take this short. This is also a bounce on the 535, which represents the 200 EMA off your anchor chart, and it come down, and if I was in that one, where would I be looking at potentially taking profits or bringing them right in, right up to 34? And we actually got a 34B. Another little tip on gold, as you know, if I'm trading most markets, I will ignore the first 34 bounce after a divergence trade, However, I tend to find that with gold you will still get these bounces and they work, so just be aware of that. Where I will quite often say I'm not going to take this trade because it's straight after a divergence trade, they seem to still work really well on gold. But here I was out with 5 and the second one out with 8, and you see my stop would have been one tick below here, providing it was no more than, at a very maximum, 8 ticks, preferably 7 ticks. So traders, that's the end of this trading session, this Q&A session. So I'll see you on the next session. Thank you very much.